Good morning, and you're watching Market Cafe on ET Now with me, Vinny Motiwala. Along with me is Harsh Saita as well. Very good morning to you, Harsh. And how did the US markets close? What's the handover that we're getting in actually?
Well, good morning, Vinny. Not so good a morning for at least US markets in India as we see it at the moment. We're seeing cuts of around 1% plus across the board in the US. We're seeing the Dow down 1%, S&P 500 down for a second consecutive day this week, fourth consecutive day in a row, and seventh out of 8 day in the decline is what we're seeing on the S&P 500, down 1.5% in trade. The Nasdaq down 2% as well. So we're seeing a lower start across the board when it comes to global cues and what global cues are indicating. Why is this the case? Well, a couple of reasons. One is that the recession is back into focus as central banks policy is also back into focus. So we're seeing a shift in the manner in which investors are now thinking. Banks and media actually led the declines. So we're seeing that largely in a recessionary environment, banks and media are the two sectors which are the most impacted, on top of which Paramount cut some of its forecasts for the rest of the year, which led to a bit of a decline on media, and Morgan Stanley is considering a 2% workforce layoff. So the layoff continues, and that's the larger picture. What investors are penciling in is that the landing is going to be harder than anticipated. So that's where we are, where US and US markets are concerned. Where Europe is concerned as well, lower. We're seeing 0.7% lower on the Dow. On the DAX, my apologies, the FTSE was down 0.3%, the CAC 40 down 0.1%, and the Stock 600 down around 0.3% as well. Where the US futures are concerned, we're seeing a slight bit of positivity, just a very slight positive bias, 0.1% higher across US futures as we speak. But that's where we are at the moment, Vinny.
Okay, that's the handover coming in from the global markets, but important development did happen in the commodities market. And when you look at the crude prices, they are once again fallen below the $80 per barrel mark. Whether you look at WTI crude oil prices, they are at $74 per barrel mark, while Brent crude oil is below the $80 per barrel mark, currently somewhere around the $79 per barrel mark. Now, this is the second time in 2022 that we are seeing that the Brent crude oil prices are below this $80 per barrel mark, and overall, this is the lowest levels that we've seen Brent crude oil prices coming in again since we saw in December or January beginning of the year as well. So yes, sentiments remained quite weak coming in terms of actually the crude oil prices as well. Now we're seeing that the prices dropped more than 1% for this 3 straight sessions coming in for crude oil prices overnight. As of now, what has opened up also, it seems a muted move coming in for WTI crude oil as well as Brent crude oil prices as well. And the main concern also comes in terms of the sentiment that has remained clouded on concerns of the weak global demand that we could see coming in as well. And obviously, let's not forget it's the OPEC Plus deciding not to make any further production cuts is something that everyone was keeping an eye out on as well. So these are the factors that are actually coming into play for the crude oil prices as of now. Yes, trading WTI crude oil below the $75 per barrel mark, while Brent crude oil below the $80 per barrel mark.
Well, absolutely. And sticking to crude, the EIA is also set to declare its crude oil inventory. They always do every week. So keep an eye out for that in events to watch today. But other than that, the major event is going to be the MPC meet and the outcome of that. Currently penciling in a rate cut of 35 basis point, rate hike of 35 basis points from that 5.9%, taking the repo to the 6.25% mark. That's where we're penciling in a rate increase, and that will obviously have a ripple effect across the economy. Banks will also start hiking their rates, and NBFCs will start facing a bit of pressure where cost of borrowings are concerned. So a couple of those factors to look out for straight off the bat today. Also, in other news, we're expecting China November trade balance data, US October trade balances data, and we're expecting in corporate action, BLS International set for a bonus issue, Lumax Industries to probably consider a proposal of a new manufacturing facility in Chakan, and the last day to buy Aptus Value Housing and Canfin Homes if you wish to be eligible for that interim dividend. So keep an eye out on all of those events to watch out for today.
Absolutely, Harsh. Interesting line of events, and surely a busy day coming in with for you, given the policy meet decision coming in. So that's the one you are closely keeping an eye out on. But let's move on and look at the global updates and what are the global top headlines coming in this morning as well. Now, the U.S. trade deficit widened sharply in October as slowing global demand and a strong dollar pushed goods exports to a 7-month low. Now, the trade deficit increased 5.4% to $78.2 $2 billion, and according to the Commerce Department report, this signals that trade could be a drag on the economic growth this quarter if this trend persists.
Well, and JP Morgan Chase CEO Jamie Dimon said inflation could tip the US economy into a recession next year. He's been saying this since a while. He said while consumers and companies are currently in good shape, that may not last much longer. He also flagged the $1.5 trillion consumers in excess savings from the COVID pandemic stimulus programs.
And Morgan Stanley is embarking on a fresh round of job cuts as a rival bank sounded caution that a looming US recession will dampen the hiring. Is cutting about 1,600 jobs, or roughly 2% of its global workforce. Morgan Stanley had more than 80,000 employees at the end of the third quarter compared to about 60,000 just before the beginning of the pandemic.
And BuzzFeed announced plans to cut its workforce by nearly 12%, or around 180 staffers. The company said the decision comes in response to challenging economic conditions and an ongoing audience shift to short-form videos. The layoffs affect the sales, production, tech and content divisions for Complex and BuzzFeed, but not BuzzFeed News or Huffington Post.
And Netflix is likely to offer multiple subscription plans with ads in the future, and the company's co-chief executive Ted said that the company recently rolled out its first ad-supported option. For viewers who don't want to see the commercials, Netflix already offers multiple plans. He also said that the company will likely do the same for its ad-supported models as business grows.
And another big news, Donald Trump's family business was found guilty of fraud and tax evasion by a New York jury. Vowing to appeal the verdict, Trump said he was disappointed and again described the case as a witch hunt. The company was convicted of enriching its top executives with off-the-book benefits for more than a decade.
And in news from Afghanistan, where at least 7 people are said to have lost their lives in an explosion near the money exchange market of Jalalabad. Now, the cause of the blast was not immediately clear, but reports suggest that the incident occurred around 1:45 p.m. This happened to be the second blast incident this week, as it followed an explosion that occurred in the vehicle carrying oil employees in northern Balkh province, and earlier this week in which another 7 people were killed as well.
Well, yes, and ET Now, Leaders of Tomorrow, since its inception, has taken cognizance of the grit and resolve of Indian entrepreneurs over the last decade. And today, in its 10th season, it is back with Leaders of Tomorrow Awards, where Honorable Deputy Chief Minister Devendra Fadnavis, Gautam Singhania, who is the CMD of Raymond Group, Ritesh Agarwal, CEO of Oyo Rooms, and cricketer Yuvraj Singh and actress Shraddha Kapoor will celebrate the spirit of entrepreneurship from 5 p.m. onwards, only on ET Now.
On that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more domestic update. How is the Asian markets opened up as well? We'll be back with all that after this short break.
Good morning. You're watching Market Cafe on ET Now with me and Vinny. Quickly moving on, the World Bank has upgraded India's GDP forecast to 6.9% for FY23. In its earlier forecast, it had pegged India's growth at 6.5% for the current fiscal year. The World Bank said that the upgrade was due to robust economic activities in India. The World Bank goes on to say that a slowdown in other emerging economies could in fact position India as an attractive alternative investment destination. Listen in to what the World Bank's India director had to say.
The World Bank projects that India's economy will grow at 6.9% this year in 2022. So we were projecting that the economy will grow at 6.5% until recently. But having said that, a good reminder that earlier on in the year we had projected a much stronger growth for the Indian economy, at above 7%. Then, given the global development, we downgraded the growth forecast to 6.5%. Now, with the recent quarterly growth numbers coming in for the Indian economy, we noted that in the second quarter, the economy did quite well.
And Dr. Arundeep Nandi of Nomura says that India cannot be decoupled from the global economy and suggests that the economy will slow down in the next year during a chat with Tamanna Inamdar on India development debate. Here's what he thinks about it. Let's go across and listen in.
Let me come to the broad question, and this is a little away from just only what World Bank is saying. So the narrative everywhere, Dr. Nandi, is that India is growing much faster than the rest. We're going to be one of the fastest growing economies in the world. And the comparative figure is always the global economic growth figure, which is much lesser than the Indian growth figure. Is that the right way to look at it for a country of our size and the base that we're beginning with?
I mean, look, I don't think that India's growth story is decoupled from the global growth story, right? So it is this myth of decoupling that we have because if you look at India's, prior growth cycles, I don't think there's ever been a phase where global growth has done badly and India's growth has done well. Right. So, yes, we are better off at this point. But if you look at, say, the time when we had the dot-com bubble, if you look at the time when we had the global financial crisis, US GDP growth fell by the peak to trough was around 4.6 percentage points or so. And for India, the growth rate also between the peak and the trough was close to 6 percentage points. So I think that the way to look at it is that the fact that the global economy is looking so gloomy means that there is significant downside risk for India's growth in the next year. Global growth is going to play a very large role in where growth is going to be next year. So it's going to hit exports. It's also going to hit investments. So India's capex cycle is actually quite linked to the global and the export cycle. So I guess sort of the concern is more from the fact that in the US, for instance, you're seeing a recession already come in the industrial and the housing sector. And I guess what is really worrying, Tamanna, is the fact that the US is in a point where it's hiking interest rates. In fact, our house view is that it could, go up to 5.5 to 5.75% as of by mid 2023. So you're actually actively trying to cool down the economy in order to bring down inflation. It's like a controlled blast, so to speak.
Well, yes, the focus continues to be on a recession globally as well as the impact of that in India. But as we approach the union budget, the banking sector is looking for a break, a tax break to be absolutely accurate. Reports say the Indian Banking Association, in a meeting with the finance minister, has sought fixed deposits up to 5 lakh rupees to be made tax-free. This apparently to make FDs more competitive with small saving tools. Just consider this. When you take a personal loan, they want you to pay over 10% interest per annum. When you put your money in the same bank in an FD, you get around 6% returns. Of course, business models are important, but this raises the question, in the era of Paytm postpaid and cryptos and mutual funds, and this era rising, are FDs still even worth it? And as banks look to the finance ministry to level the playing field, we question, will FDs become tax free soon? And in the bargain, we caught up with Kamlesh Gandhi of Mass Financial and Ajay Baga of Element Platforms. Listening to a slice of that conversation.
See, what I understand from IBA representation is they're asking for a level playing field. So if we take from that point of view, that if similar investment in mutual fund or maybe in insurance or maybe in schemes like NSS, where it is taxed at the end, they are at a disadvantaged position. I am not in judgment whether government will pay heed to this demand of IB or not. It all depends upon what government can afford at the end of the day. From the domain I come from, what I understand, that if something is done in this direction to make deposits more attractive, and banks also getting a good chunk of the savings from the people, the advantage is that unlike other other instruments that such as mutual funds or insurance and all, where their further investment is to a select class of the society, whereas the banks is all pervasive.
Credit deposit ratio is increasing. Basically, banks require more funding in a strong economy where the credit demand is coming back after a number of years. We are seeing credit demand coming back both on the retail side as well as on the corporate side. To meet this demand, the banks are looking for funding sources, and the fixed deposit, which offers very low returns. The returns have been increased by banks recently, but it is not a tax efficient instrument.
On that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more news, more update after this break.
Welcome back. You're watching Market Cafe with us on ET Now. Quickly moving on, we'll take stock of where Asian markets are at the moment. We're seeing cuts across the board in Asian markets, and that's largely on the back of slightly negative global cues. I did speak about the US markets, all down 1% plus, at least in trade yesterday as well as day before. So we've seen a couple of days of red on US, and that's trickling down to Asia as well. The Nikkei down around 0.2%, the Shanghai down 0.25% as we speak. The Hang Seng holding on to some amount of gains, but that's largely on the back of the fact that China has started to relax some of its virus rules, and that's playing a bit of a positive effect, or having a bit of a positive effect on the Hang Seng. Moving quickly on to the Kospi, down around 0.1% or thereabouts, and the ASX 200 also down around 0.9%. So we're seeing cuts across the board. 0.4% down is where the ASX 200 currently is at. Moving quickly on, we did speak about oil. Oil prices have climbed slightly, and that's largely on the back of a couple of factors. OPEC Plus keeping output cut targets, output cut targets, my apologies, and of course the China easing some of its lockdowns, and that will have an impact on oil going forward. But moving quickly on bond yields, US 10-year bond yield currently at 3.5% on the back of course, mid-December FOMC meeting. So look out for the 10-year bond yield over the next week or so. And we're also looking at around 105 on the dollar index. That's where we are at 105.6 on the dollar index as we speak on your screens. Gold in the bargain has come, or rather has gained slightly. It's now just below that $1,800 an ounce mark. It's up around 0.1%, $1,785 an ounce is where it's at the moment, and that too is in close correlation to the dollar index. In fact, inverse correlation to the dollar index is where gold generally is at. But that's broadly where we're looking at in terms of the larger macros as well as how Asian markets have started off.
Okay. A bit of a muted start is what we're expecting from the Indian markets, but all eyes are on the RBI's monetary policy meet, and going by the word on the street, it is very unlikely that the central bank will pause on the rate hikes in the last meet of this year. Experts believe that the MPC would or could actually raise rates by 25 to 35 basis point. In fact, 100% of the respondents and according to ET Now's poll believe that there will be an increase in rate hikes, and they will also closely be looking out for the commentary around the growth going forward as well. We spoke to Swarnal Verma of Nomura on what are their expectations, what are they watching out from the MPC meet. Let's go across and listen.
We are expecting a 35 basis point increase, so that should take the repo rate to 6.25. I think that's broadly expected. What will be a lot more important this time actually is the forward guidance that the MPC gives, because the effective rates have moved from the lower end of the corridor at 3.35 now to 6 or above, after the decision tomorrow. So given the lagged effects of monetary policy, I think the forward guidance is what will be a lot more important than the rate hike where a step down is expected. So the second quarter GDP number at 6.3% was actually bang in line with what the RBI was expecting. Although some of the high frequency data, particularly around exports and industrial production numbers, are suggesting that post-September, there has been a deceleration in the economic momentum. So while H1 is in line, second half of FY23 should be slightly lower. So the 7% projection that the RBI has, they could either retain it but flag downside risk or marginally lower it by 10 or 20 basis points, but not substantially. Now, I think what is more important is the FY24 growth projection, which they have right now at 6.5%. And, given the impact of this year's tightening cycle will be felt in FY24 more notably, and the global outlook for 2023 calendar year being weak, we do think there are downside risks to the FY24 projection of 6.5%. It's not clear the RBI will make the downgrade this time around, but our own view is FY24 GDP will end up closer to 5.2% versus the 6.5% that the RBI has right now.
Well, yes, that all important MPC outcome coming out today, 10 a.m. of course, live on your channel. Quickly moving on, the winter session of Parliament is all set to kick off from the 7th of December. 16 new bills have been listed for consideration, and the government will be hoping to push through 23, including 7 pending bills. However, key economic bills are missing from the listings. My colleague Prakash Priyadarshi filed this report yesterday with all of those details.
See, the winter session of Parliament is going to be commenced from December 7, and government has listed 23 important bills for the Parliament to consider. Out of these 23, 16 new bills are there, and 7 pending bills are there in the list of business. 3 important Parliament Standing Committee report will also be submitted on the floor of the House. However, it seems that this session is going to be lackluster in terms of key economic bills. The key economic bills such as Competition Amendment Bill, bill related to amendment in IBC is not there in the list of business. Also, Banking Amendment Bill, Insurance Amendment Bill is also out of the list of business. Government has also not listed personal data protection bill for the winter session of Parliament. Consultation process on these key bills are underway, and it is yet to be cleared by Cabinet. However, some important bills are there in the list of business for the winter session of Parliament. That is Trademarks Amendment Bill 2022, which seeks to simplify registration and managing process of trademark worldwide. Also, the Forest Conservation Amendment Bill, Multi-State Cooperative Societies Amendment Bill 2022 is also there in the list of business for the winter session of Parliament.
Okay, and the wedding season gets under in the full swing, and ITC is hopeful that the spending in FMCG space will go up. The price points of products in premium and mid-level are doing well for the company, especially in the personal care segment. We caught up with Sameer Satpathy, the chief executive at ITC for their personal care business, who is upbeat about the future as well. Let's go across and listen in.
Diwali has been interesting because this is the first Diwali we've had after 2 years, and consumers were out, they were spending money, whether be it on food, on some other items of daily use. When we look forward, I think there are a lot of marriages which are scheduled over the next 45 to 60 days. So presumption and the hope is that there will be expenditure, maybe directly or indirectly, which will impact FMCG positively, because the money circulation would increase definitely in the country.
Having said that, input costs, palm oil prices have been volatile. How has it affected the margin, and what's the outlook going forward for 2023 as well?
So I think I would love to hear the outlook from you, because see, the thing is that what we have learned over the last 2 or 3 years is that fluctuations are part of life. So whether it be raw material fluctuations, something or the other doesn't go as planned. So the entire emphasis is that the way we plan is that what do we do if it doesn't go as per plan. So how to build resilience in your systems, in your supply chains, in your formulations, in the way you work the market, so that you can overcome all these challenges.
So in terms of personal care, since you head it, and what kind of trends have you seen, and what's really doing well for ITC?
So what we are seeing is premium consumers, premium channels, they have tended to do well. Premium outlets, they tend to do well. What is doing well is, I think the more expensive things are doing much better, and the more affordable things. So there's the middle class in the middle, which is a bit not as good, but premium stuff and the price point products, I think both are doing well.
Well, yes, very interesting comments from ITC, of course, but I'll quickly move on. We have both Vamakshi as well as Lisa with us in the studio, and I'll throw it straight to Lisa. Lisa, talk to us about all the stocks that are in news today.
Well, good morning. Starting with Infosys, the open market buyback opens today, and the maximum buyback price will be at 1850 rupees and the buyback size will be 9,300 crore. With HDFC AMC, the promoter Aberdeen Investment will be selling entire 10.2% stake in the company, where the stake is valued at 4,500 crore. Aberdeen Investment Management will cease to be a co-sponsor of HDFC Mutual Fund. The 9.9% stake will also be sold to a single buyer. In August, Aberdeen Investment had also sold 5.6% stake worth rupees 2,300 crore. Craftsman Automation, the Abu Dhabi Investment Authority, White Oak Capital and India Econ will acquire 3.3% stake, while Marina Singapore will be selling 5.5% stake worth rupees 370 crore. Bikaji Food has reported its first earnings after listing, where the revenue rose 32% and PAT was up 44% year on year. For the falling edible prices has improved the margin, and double-digit growth revenue was observed in all the categories. Ercon has received Sri Lanka railway orders worth rupees 122 crore, while Siemens is the lowest bidder for locomotives project in Gujarat. Lastly, on IFL Securities, they'll be transferring their online retail trading business to 5paisa Capital, and the transfer has been done to reorganize and consolidate its online trading business. The IFL online trading business is valued at rupees 199 crore, and IFL security shareholders will be getting 1 share of 5 paisa for every 50 held. So these are the stocks that will be in focus for today's session.
Okay, thank you so much for that, Lisa. But the mutual fund arm of HDFC will see its promoters, Aberdeen Investment, sell its entire 10.2% stake in the mutual fund business. The company told the exchanges that the promoters wish to sell around 9.9% stake to a single buyer and the rest to others. Post the required approvals, Aberdeen Investment will cease to be the co-sponsor of HDFC Mutual Fund, and this is under the SEBI regulation. So on the back of that, we'll also be keeping an eye out on HDFC AMC as well as the HDFC stocks as well. But let's move on, and Vamakshi, as always, you're here with us to tell us what are the brokerages saying this morning, and also a very good morning to you.
Well, good morning to all of you all. I'll just take over from you, Winnie. Let's first start off with HDFC AMC. Now, Jefferies has come out with a report, and they say that HDFC AMC's foreign promoter is expected to sell stake. The identification of the buyer may in fact address the share supply overhang in their opinion. But on the back of that, they've maintained a buy on HDFC AMC and given a target price of 450 per share. Now, the next stock in focus is Dabur. We have a note coming in from Morgan Stanley, and they are seeing accelerating signs of rural recovery. They're also seeing an improvement in the portfolio mix. Favorable relative valuations are making a strong case for the stock outperformance as well. Now, they're also expecting the top line growth and margins to improve in the second half of FY23 as well as in FY24. So, on the back of that, they've in fact upgraded their rating on Dabur to an overweight and given a target price of 660 per share. And lastly, we will be keeping an eye out on all banks after Morgan Stanley has come out with their outlook for the year 2023. They're expecting another strong year from the banks given sustained growth. They're expecting private banks such as ICICI Bank as well as Axis Bank to gain strong traction going ahead. And within the PSU banks, their top picks are Bank of India and Bank of Baroda given the strong cyclical tailwinds. The banks with access to retail deposits, in their opinion, should also generate higher profitable revenue. So on the back of this note, they have maintained their overweight call on ICICI Bank, Axis Bank, Federal Bank, AU Small Finance Bank and IndusInd Bank.
Well, thanks a ton for all of those updates, Vamakshi, as always. But we'll quickly move on and on to an ET Now report. Feroz Mistry, who's 26, and Zahan Mistry, who's 24, both sons of late Cyrus Mistry, have formally joined the Shapoorji Pallonji group. They will be guided by top group professional executives close to the development, have said. Feroz and Zahan will work for about 18 months in various group businesses and verticals before taking on executive roles. Cyrus Mistry, former Tata Sons chairman, died in a car accident on the 4th of September.
Okay, and brokerage firm Nuvama expects Adani Power, Varun Beverages, ABB, Page Industries among the stocks that may enter the Nifty's next rejig slated in March next year. Somit is joining in with us with more details on that. Somit?
If you see for the Nifty, the rejig is expected to happen on March, and the market cap cutoff date for this rejig is January 31st, and the announcement date will be in the second half of February 2023, and the effective date for these changes would be March 31st, 2023. Now, for Nifty, analysts are not expecting any major change, but they are also saying that stocks like Avenue Supermarts, Adani Green and Adani Transmission could make the cut if they get included in the FNO segment. For Nifty IT and Nifty Bank, again, analysts are not expecting any major change. But when it comes to Nifty Next 50, there are a host of changes that are expected. Now, on the inclusion side, there are 4 high likely inclusions, where while 4 of them could get out. Now, on the inclusion side, if you see Varun Beverages, Page Industries, Adani Power and ABB India have high chances of getting included in the Nifty Next 50 index, and the inflows that are expected in these 4 stocks is in the range of around 21 to 42 times. But keep an eye out for Page Industries and Adani Power, because the inflows that are expected in these 2 stocks are nearly 3 times their average daily volumes. And when it comes to exclusions, Bandhan Bank, Emphasis, Biocon and Gland Pharma are most probably getting excluded from the Nifty Next 50, and the outflows could be to the tune of around 14 to 26 million US dollars. But keep an eye out for Biocon and Emphasis, because the outflows expected in inclusion, these two stocks are nearly 1.5 to 2.2 times their average daily volumes. Now, other than this, the brokerage also mentions that Adani Wilmar also has a chance to get included, but the chances are less likely at this moment, while Trent and TVS Motor are also on the borderline to get included in the Nifty Next 50. Now, when it comes to Nifty 500, lastly, on the inclusion side, there is Adani Power, Piramal Enterprises, Piramal Pharma, Gillette, UCO Bank, 5-Star, which is the recently listed company, Medanta, again a recently listed company, and KICL. While on the exclusion side, there's Bharat Rasayan, SIS, PNG Health, Symphony, Indico Remedies, Moil, Shyam Metallics, and Sheela Food.
Okay, Somit, thank you so much for that update coming in this morning. But with that, we're absolutely out of time on this edition of Market Cafe. SGX Nifty indicating a muted start. Don't go anywhere. The markets will take the action forward further.